Last week in Beijing, Mark Carney said something that, 5 years ago, would have been political suicide for a Canadian leader. Standing just a few miles from the Forbidden City, the man tasked with steering Canada's economy looked at the cameras and said, quote, "China has become more predictable than the United States as a trading partner." Let that sink in for a second. Canada is a founding member of NATO. We are a NORAD partner. We are part of the Five Eyes Intelligence Alliance. For 80 years, our entire survival strategy has been built on one single, unshakable assumption. The United States is the rock, and everyone else is the variable. But Carney just flipped that logic on its head. He's telling us the rock has crumbled. Now, I know what some of you are thinking. I had the same reaction. I looked at that statement when it crossed the wire, and my first instinct was denial. I thought, this is dangerous. This is a betrayal of the alliance. I thought about our history, our shared border, our shared values. But then I forced myself to stop looking at the politics and start looking at the math. I pulled the trade data coming out of Washington from November 2025, and I realized something terrifying. Mark Carney isn't being anti-American. He isn't trying to make a political point. He's just being the only adult in the room who can read a balance sheet. Because the numbers we're seeing from the US Department of Commerce aren't just bad, they are catastrophic. They signal a structural break in how the global economy functions. And they explain exactly why Canada is quietly, but frantically, building a backdoor exit from the American economy. Today, we are going to look at the 3 signals that prove the America First policy has officially backfired, and why Canada's pivot isn't a choice anymore. It's a survival mechanism for your job, your dollar, and your future. To understand why Canada is moving, you have to understand the scale of the disaster that just happened south of the border. Back in 2024, the theory behind the tariffs was simple. You remember the pitch. Tax imports, make them expensive, and Americans will buy American. Domestic manufacturing booms. The trade deficit shrinks. America wins. That was the theory. And on paper, to a voter in the Rust Belt, it sounded like common sense. Here is the reality of November 2025. According to the latest official release, the US trade deficit didn't shrink, it exploded. In a single month, it jumped by 94.6%. It went from roughly $29 billion to nearly $57 billion. That is almost double in 30 days. This isn't a rounding error. This is a system failure. So what actually happened? It turns out global supply chains are a lot more complex than a campaign slogan. When the administration slapped a baseline 10% tariff on everything and a 40% tariff on critical raw materials like aluminum, they didn't punish China, they punished American factories. Think about a construction company in Ohio versus one in Ontario. The company in Ohio is now paying 40% more for their steel beams than they were 6 months ago. Their margins are wiped out. They can't bid on international projects because their input costs are artificially high. Meanwhile, the company in Ontario, we have access to global markets at global prices. So instead of a manufacturing boom, the US saw a manufacturing freeze. Exports collapsed because American goods became too expensive for the rest of the world to buy. And because American consumers, people like you and me, knew prices were about to skyrocket further, they panic bought everything they could get their hands on from overseas. Imports surged 5%. But here is where it gets personal for Canada. And here is the price tag of instability. Look at Volkswagen. For 2 years, there was a bidding war between the US and Canada for the next generation of EV infrastructure. The US offered massive subsidies. They threw money at the problem. Billions of dollars in tax credits were on the table. But last month, Volkswagen quietly announced they were canceling plans for their new Audi factory in the United States. Why? They didn't cite labor costs. They didn't cite energy. They cited policy instability. Think about the weight of that decision. A global manufacturing giant looked at the biggest economy in the world, looked at the subsidies, and said, "No thanks. We can't build a 20-year factory in a country where the trade rules change every time someone sends a tweet. Instead, they are doubling down on their St. Thomas plant right here in Ontario. This proves what we've been arguing on this channel for a year. Capital doesn't chase the highest subsidy, it chases the lowest risk. And right now, for the first time in modern history, the United States is the high-risk option. So, the U.S. economy is overheating and shutting down simultaneously. What does a country like Canada do? We share a 9,000-kilometer border. We send 75% of our exports to them. Our entire logistics network runs north-south. If they go down, the physics of our economy says we go down with them. Not if Mark Carney has anything to say about it. What we are witnessing is the deployment of what analysts are calling the rooting around strategy. Think of it like a highway system. For 80 years, all major trade roads went through Washington. If you wanted to clear a transaction, you used the US dollar. If you wanted to ship goods, you used US lanes or US guaranteed security. Now Washington is setting up toll booths, roadblocks, and random inspections every 5 miles. So what is Canada doing? We aren't fighting the roadblocks. We aren't trying to burn down the toll booths. That would be suicide. We are just paving a bypass. It isn't betrayal, it's logistics. Look at the deal Carney just preliminary signed in Beijing. On the surface, it looks confusing, almost contradictory. Canada kept the 100% tariff on Chinese electric vehicles. We kept the hard line on that to keep Washington happy. It's optics. It keeps the border open. But look at the fine print. In exchange, Canada opened up access for agricultural products and critical minerals processing. We traded a symbolic victory on cars for a survival lifeline on food and resources. It's pragmatism over ideology. And we aren't the only ones. This is the part that American media isn't showing you. Look at Europe. On January 27, 2026, the European Union and India finalized their free trade agreement. Now, trade deals happen all the time. Why does this one matter? Because of the scale. This deal covers 25% of the global GDP. It creates a massive free trade zone of 2 billion people. And here is the feature, not the bug. It explicitly excludes the United States. European Commission President Ursula von der Leyen called it proof that cooperation is the answer. That is diplomatic speak for, we are building a lifeboat and there isn't room for America first. Usually these deals take 10 years to negotiate. This one took months. Why? Because the Brussels effect and Indian manufacturing scale needed each other to survive the American tariff wall. This is the pattern. Allies are no longer waiting for the U.S. to come back to its senses. They are assuming this isolation is permanent. They are building a global trading architecture that simply goes around the United States. The structure of global trade is physically changing. Supply chains are being rerouted. Ports in Prince Rupert and Vancouver are seeing different traffic patterns than Long Beach. We are watching the world adapt to an isolated America in real time. But trade is just physical goods. You can move a factory. You can reroute a ship. It takes time, but it's visible. The real danger, the one that keeps central bankers up at night, and the one that should worry anyone with a mortgage in Canada, is what's happening to the money. I am not a financial advisor, and this is not investment advice. I'm analyzing geopolitical capital flows. For the last century, buying US Treasury bonds was considered risk-free. It was the safest place to park money on planet Earth. If the world panicked, they bought dollars. But look at Japan. Japan is the largest foreign holder of US debt. They hold over $1 trillion of American IOUs. And in November, quietly, without a press conference, they started selling. Why? Because of something called risk-adjusted return. When the U.S. trade deficit widens by 94%, it means the U.S. government has to borrow more money to fund its operations. It has to print more dollars. Usually, that's fine because the world always wants dollars. But what happens when the world is actively building trade zones that don't use dollars? You get what finance guys call a reverse dollar milkshake. Let me explain this mechanism because it hits your wallet directly. The dollar milkshake theory usually says that in a crisis, the US sucks up all the global capital like a giant straw. The US gets stronger, everyone else gets weaker. But this time, the straw is broken. The policy chaos, the 94% deficit, the legal battles over tariffs, is pushing capital out. European pension funds, traditionally the most conservative, boring investors in the world, are reducing their exposure to US assets. They aren't panic selling, they aren't dumping everything, they are just trimming. But when you trim a $30 trillion market, the earth moves. So how does this hit you in Vancouver or Calgary or Toronto? Here is the chain reaction. If foreign investors sell US bonds, the US has to pay higher interest rates to attract buyers. US interest rates stay higher for longer. The Bank of Canada is then trapped. If we lower our rates to help Canadian homeowners, our currency crashes against the US dollar, causing massive inflation on imported food and fuel. So we might have to keep our rates high just to defend the dollar, even if our economy needs a cut. This is the financial trap of being next to a chaotic giant. This is why the pivot to India and the pragmatic deal with China are so critical. We need to generate demand for our resources that isn't tied to the US financial cycle. We need revenue coming in euros, in rupees, in yuan. It's not just about trade. It's an insurance policy against our own interest rates being held hostage by Washington's mistakes. So, where does this leave us? Mark Carney's statement in Beijing wasn't just a soundbite, it was a notification. It was a notification that the era of automatic alignment is over. For decades, we've lived by the saying, when the US sneezes, Canada catches a cold. That has been the fundamental truth of our existence. We accepted it. We planned for it. We acted like the little brother who just had to endure the weather. But that era is over. Now, when the US catches a fever, a self-inflicted high-tariff fever, Canada is finally learning to wear a mask. We aren't leaving the continent. We can't move the geography. We are always going to be neighbors, and we are always going to be friends. But we are growing up. And more importantly, we are realizing that we hold the cards. Think about it. The rooting around alliance, Europe, India, Asia, what do they need? They need energy. They need food. They need critical minerals. Canada has all three. The US needs those things too. But they've decided to put up a wall. The rest of the world is building a bridge. The data from November 2025 proves that the US is currently on a path of economic isolation. That is their choice to make as a sovereign nation. But it is Canada's choice whether we follow them down that path. And judging by the factories in Ontario, the ports in BC, and the ink on the treaties in Beijing, we have made our decision. Sovereignty is expensive. It costs effort. It costs risk. But dependence? Dependence on a partner who has lost their way? That is fatal. Thanks for watching. If you want to understand more about how the Arctic is becoming the next front in this sovereignty battle, watch this video here. Keep your eyes open.